Welcome to a special episode of the Real Estate Forum, a podcast from the Paul Milstein Center for Real Estate at Columbia Business School. I'm your host, Raphael Sidelsky. This episode features the closing keynote fireside chat from the 17th Annual Columbia Business School Real Estate Symposium, held on December 4th, 2024, at Columbia Business School's Manhattanville campus. I had the pleasure of moderating a fascinating conversation with Ryan Cotton, a partner at Bain Capital. Ryan is the head of Bain Capital Private Equity's Global Consumer Vertical and also serves as the head of Bain Capital Real Estate. I hope you enjoyed this insightful discussion on Ryan's unique investment background and mindset, along with the key real estate focus areas at Bain.
Hello, everyone. I'm really excited to be here and to lead this keynote session with Ryan Cotton. Ryan has a fascinating and atypical real estate background and investment mindset. Ryan, thank you for joining us.
Pleasure.
I would like to kick things off by discussing the sort of Ryan Cotton origin story and how deviating from the herd has led to many of your successes. And I'd love to just start off with how and why you decided to study philosophy at Princeton, and then went from there to baseball operations at the Red Sox, and then on to Bain Consulting and Bain Capital.
Sure, prototypical real estate resume. First, it's excellent to be here. Thank you guys for making time to listen to me and spend some time together. I'm humbled to be in this room of people who've spent their lives thinking about and studying real estate, and recognize that I may have a bit of an outsider voice or perspective in that, but excited to have that conversation. As Raphael said, I've sort of been cursed in my life with curiosity. My favorite word in business is curiosity. I think the very best thing you can be as an investor is curious, is this desire to ask why, to understand what's going on at the most fundamental levels you possibly can to build conviction. And so for me, being a philosophy major was sort of an exercise in curiosity. I was curious about our world. Why are we here? What does it all mean? How do we organize it? How do we think about it? And that was a rewarding journey for me, but it actually doesn't lead anywhere. It leads to just more questions. And so I started to get, more into some tangible things that I could sink my teeth into. And I had a lifelong passion for baseball, played it as a kid, and got the chance to go work for the Boston Red Sox when I was in college, doing the early days of Moneyball. This was the late 90s and the Billy Beane era, and 5 or 6 teams trying to figure out how do you apply science to baseball, to art. And I loved it. I loved the competitive element of it. I loved the chance to sort of, have a track record. You win and you lose every day. You get a referendum on the product you're putting on the field. That said, it was a tough career path. It was a tough career path back then. The youngest general manager in the history of baseball was 45 years old. I was 20. That seemed like a long way away. I was gay. That seemed like a real big obstacle. Probably still seems like a real big obstacle. And, it doesn't pay very well. And so, staring that down at 20 years old and saying, do I want to devote my life to something where I'm an outsider and disadvantaged and making $27,000 a year? That didn't seem like, the career path I was looking for. And so I scrambled my way to the only people who would take a chance on me, who were, very graciously Bain & Company, the management consulting firm. I think they had a general athlete orientation and saw in me something I'll always be grateful that they did. It was also helpful that the hiring manager at the time wanted me to run his fantasy baseball team. So I did that. He won his league, and I got a job, and learned a ton. I got to say, being a management consultant is like the best crash course in business you can have. You think strategically. You ask why a ton. You learn a bunch of tools and frameworks, and that really excited me. But what I missed in that was what I loved about baseball, was winning and losing every day, was having a track record, was feeling like there was something on the line with what we were doing. And so, as I learned about private equity and alternative investing, this idea of taking the skills I had built as a consultant and then using them to risk capital, to put your skin in the game and actually build a track record, it was an easy sell for me. And so now 23 years ago, I left Bain & Company and went to Bain Capital to start becoming an investor. And I didn't think I was going to make it 2 years, and here we are 23 years later. So it's been an unbelievably rewarding career at a place that I love greatly. So that's me.
So you began your in sort of investment approach in the consumer sector, and you did a lot of successful deals there. One of the highlights was...
Oh, thanks. Sure.
One of the highlights was your investment in Canada Goose, which led to a 20 multiple. Are there any particular lessons from that investment or other things in the consumer space that piqued your interest and led you to get involved in real estate?
Yeah, sure. Look, I think being a good investor is really an exercise in self-knowledge, right? It's knowing what you have that's differentiated, that allows you to see the world differently. And that difference is the definition of alpha. If we all had exactly the same view on something, well, then that view is priced in, and that's beta. It's where you have an orthogonal view or a different point of view that you can create alpha. And finding that self-knowledge is really about thinking about where your essentialities lie, where your skill set, what makes you different. And there's two questions I find really helpful in this. The first is sort of, what's my altitude of differentiation? I've sat in a lot of macroeconomics classes in my life. I am at best a middling macroeconomic investor. George Soros is better at this than I am and always will be. And so I probably shouldn't be betting on interest rate swaps and, derivatives and futures contracts. That's not something I have altitude for. My altitude has always been about thematics, and it's been about trying to understand the deeper why that shapes markets, how we live, play, work, shop, how that's changing, and how that changes what's necessary in the commercial ecosystem around it. That's the thing I've always sort of had passion for as an investor. And what I learned at Bain Capital was how you build platforms that are competitively advantaged to take advantage of those shifts in the world and in the ecosystem. And so when you marry those two things, identifying the future today and building a platform that's competitively advantaged to go take advantage of that future, well, to me, that's a really powerful skill set for creating alpha. And so Canada Goose was just an exercise in recognizing that there was a gap in what consumers needed. A lot of cold people in the world who didn't have a very good coat, and along came a coat that if you could afford it, it made you warm. Pretty effective product, it turns out. The science then was about how you go build a business and a system that can sell that message to the world, with product diversification across channels, across geographies. And, our success in doing that, getting those two things right, is what drives that kind of, convex outcome. It's also what drew me to real estate, though. I think the last panel was fascinating because we sat around and talked about how there are some very fundamental shifts happening in the world of real estate today. I'm sure we'll spend more time talking about it, but as a thematic investor, as somebody who likes to look back and see those bigger patterns, those bigger shifts happening, you can't help but be really excited about what's happening in real estate today. And so when the opportunity came along for me to systematically go about building a competitively advantaged platform to take advantage of those shifts in capital, well, that was something I just couldn't resist. It plays absolutely to my altitude as an investor, to my competitive edge as an investor, and more importantly, taps into the how about how I like to do that, which is in collaboration with people, to build great partnerships, to make 1 and 1 equal 3. And so by teaming up with a whole bunch of really talented, deeply experienced real estate experts and applying a slightly different lens of curiosity, that question of how, and a lot of thematics, I think we can construct something. I think we have constructed something that is really differentiated and is the product that the market doesn't know it needs yet, but is headed towards. And so to me, in this journey of career exploration and curiosity, that was something I couldn't pass up and something I'm really excited about.
That's great. So the story of how and the why Bain got into real estate, you touched on a little bit of the why. In terms of the how, that's also an interesting story. So let's discuss that for a bit. And prior to W5, I actually led investments at C3 Capital Partners, and Harvard's endowment was our lead investor. And they had a big, smart real estate investment team. And the formation of Bain Capital was actually you lifting that team out of the Harvard endowment into Bain. Why did you decide to take that approach, and how did you bring them into the Bain culture?
Yeah, it's a unique version of growth for Bain Capital. Usually it's organic, we home grow, we develop our own businesses, and this was a bit of an acqui-hire merger hybrid, and so unique for us. But the journey was very Bain. We started thinking about real estate 15 years ago on the heels of the GFC. I think everybody remembered the RTC. Everybody thought, values have traded down. This is the time. Back up the truck. Let's go buy real estate. And I got asked to start thinking about that on behalf of the firm. What would our strategy be? What should we do that? And how should we play? And I came back to the firm 15 years ago and said two things. One was, if you want to make the beta trade, go make the beta trade. Go buy a REIT. There's way more liquid ways to go play this moment in time in the cycle of real estate than to build Bain Capital, a new business unit. But at the same time, I felt like there was a gap that we could identify in the real estate investing universe for this thematic value add operationally intensive style of real estate. You heard the last panel say the lines between private equity and real estate are starting to blur. And we saw that 15 years ago, and we wanted to blur those lines. We wanted to get into that business and bring our business building, platform building skills to real estate. The question was how. And so we spent a lot of time looking for talent. I mean, there's real humility, I think, that needs to sit behind the model that I'm not a real estate expert, and we as a firm, we're not real estate experts. And so we needed people who had that expertise to blend together with our curiosity and to build the product we wanted to build. And so I set about meeting a lot of folks, and I interviewed a lot of people who ran some of the real estate greats of the GFC. And I'd always ask just one question, tell me about an investment you're really proud of. And the pattern I noticed was nearly everyone would immediately tell me a war story. I found this person who had this hotel and they got stuck in a bad loan and the broker was my neighbor. And so I got him in a moment of weakness. And at the closing table, I dropped the hammer. And when all was said and done, I bought the hotel at 67 cents a replacement cost. I'm an awesome investor. And it's great. Like, that sounds like a terrific investment. Why did you want to own that hotel? And, everyone would look at me like I had three heads and say, well, didn't you hear me? It was cheap. And well, that's not actual why-based investing. That's transacting. That's deal making, which is important and a vital skill. But I want to start the conversation with why. I was looking for someone who came into the room and said, I saw the world changing. We needed more of this. And I wanted to go own that as a result. And it was really hard to find. It validated for us that there was a gap in the world. There was a product gap of people who led with the why, but it was hard to build that business. Until in 2017, there was a bit of a moment of kismet that we met the team at the Harvard Management Company. They had done a phenomenal job for the Harvard Endowment. They had radically outperformed the rest of the endowment's book. They'd grown in allocations to an unsustainable level and sort of got the edict from above that we need to diversify away and you need to sell down because you're too much. And that didn't work. They'd built platforms that needed to be fed. They had winning investments they wanted to keep doubling down on. And obviously it was a team built for growth. And so that was a fundamental mismatch. And I think both sides recognized that. And Harvard called us and asked us if we'd take a look at their team and think about, could we partner with them to be the future capital solution? And so we met then with the team there led by Dan Cummings, who's a 42 now year real estate veteran and a bit of a legend of the space. And fascinatingly, through his own experience, Dan had arrived at a business plan that looked exactly like what we had written at Bain Capital. The meeting was funny. He walked in and said, you're not going to like us. We're not like anybody else in real estate. We said, try us. And he said, well, here's who we are. And we pulled out a piece of paper that said, here's who we want to be. And it was the same thing. And we knew that was a really great match. And so we lifted that team. We took over managing the back book of real estate for Harvard and their endowment, but we started raising third-party funds in 2018. Behind that team, conjoined with some Bain Capital resources to really be the product we'd been looking for. And now we're on our third fund in that series, and the platform's 80 plus people and a significant part of Bain Capital. But it was a unique formation journey born of two parallel visions, honestly.
You talk a lot about alternative and thematic investing as being a driver for what you do that's different in the real estate space. Love to sort of walk through with you how you determine which themes and sectors are going to be, as you say, on the right side of history for real estate at sort of this moment in time.
Sure. Well, let me set the stage a little bit for why I think this matters. And you heard some of this on the last panel. If you went back 40 years ago and looked at capital in real estate, 56% of real estate capital was invested in office buildings and retail. If you went to 2022, so just 2 years ago, 52% of real estate capital was invested in office buildings and retail. 40 years in which you had the birth of the internet, globalization, work from home, massive changes in the way we live, work, play, shop. And yet, the real estate industry kept buying the same office building, kept buying the same mall, and just riding beta and writing cap rate compression to create some returns. That is not the case in corporate equities, the world I came from. If you go back and you bought 40 years ago the constituent parts of the S&P 500, you just bought the companies at their sector weights 40 years ago, you would have earned a 3% return from then to today. The S&P earned an 11.5% return from then to today. Why? Because it rebalances itself all the time. Because you own the Magnificent Seven in the S&P 500 today, and if you bought them 40 years ago, you don't. You own railroads, and you own AT&T, and you own IBM. And we saw in that this opportunity to bring more dynamism, more thematic sector allocations to the world of real estate and think beyond those traditional 4 food group labels and really start to question, where are we going? What do we need more of? And how do those changes in how we behave manifest themselves in real estate? And so our process starts with identifying secular demand drivers and then really thinking about where is that demand mismatched with supply. So I'll give you 2 examples of what constitutes a secular thematic for us. One is the life sciences ecosystem. And I get that it's easy to rag on that right now. It was a bit of a bubble in time, and there was a lot of capital to chase that in 22 and 23. But I have almost as much conviction in that sector as anything I've ever invested in today. Why? Because the secular thematic is fundamentally strong. The ROI on drug discovery goes up every single day. We sequenced the genome. We learned how to commercialize that product. That increased the hit rate on our R&D so that we can target specific genetic markers, and we know that it's going to work. Now we have new modalities like mRNA vaccines that further raise that R&D, because we're not just taking shots in the dark, we're tailoring drugs now. And so I know it will work. I know what the market size is. That ROI is very high. Now we have AI that allows me to process data faster from my experiments, get to insight quicker. The ROI goes up. And as that ROI goes up, more money comes into drug discovery. That's why you had a bubble in pharma. That's why you had a bubble in biotech, because that ROI got really high and a lot of capital chased it. Now, too much capital chased it at too high a value, and that's the definition of a hype cycle in a bubble. But over a 20, 30-year period, I'm certain we'll be doing more drug discovery 20 years from today than we are today. I can tell you there will be more demand for lab space 20 years from today than there is today. I cannot tell you that about a Class B office building, but I can tell you that about a lab space. That, to me, is the definition of a secular thematic. You got to get the timing right, you got to get the product right, we can talk about all of that, but that's a really interesting secular thematic. The other way we come at secular thematics is to think about those acute supply-demand mismatches. So if you take housing, a sector that, we all fundamentally understand the thematic. Population's growing, America's underhoused, therefore invest in multifamily. That's totally rational to me. But I think you can refine that a click by asking yourself, where are there dislocations in that supply-demand graph, be that a geographic dislocation or a demographic dislocation, that create opportunities. And if you really think about where that housing demand is coming from, there's 2 above average drivers of growth in the demography right now. One is aging baby boomers who are increasingly becoming seniors and who will increasingly need specialized housing for their aging, and sort of the 25 to 35-year-old segment of the population that's changing the way it forms households. 30 years ago, everybody got married and had kids at that point. Now we live on our own. We protract family formation. And so we need more housing for that 20 to 35-year-old segment of the population than we did in the past. We're 2 for 1 almost. And supply has not responded in either case. And so I'm really bullish about senior housing over the next 10 years. The demography is obvious. The demand wave is coming. We are not developing enough supply into that. There's a reason that the public REITs of seniors have ripped this year, because the world has caught up to that insight. We've specialized in developing a type of multifamily product that is a tiny apartment home rental, 1,000 square foot home on a 1/10 of an acre of land that you can rent for your dog. You can pull your car up to the front of it, and it kind of feels like a house, but it costs 40% of what SFR costs. And so if you're a 27-year-old forming your household for the first time, it's a safe, comfortable product, but it's also in your price point. And there's not enough supply of that for you. And so if I can pick those spots where that curve is uniquely mismatched, well, then I can create, better sector beta, and I can create alpha on top of that. To me, that's what thematic investing is all about. And that's what we really try to do, is that process of curiosity, asking why, figuring out how those fundamental shifts are affecting real estate, and then trying to get there before the market catches up.
One of the critiques that people make about non-traditional real estate, and we heard it when I was at the Bechtel family office at Fremont Group, we did a lot of non-traditional real estate, and people would say, well, what about the alternative use? You're doing a 100-foot clear-high cold storage facility, and if it doesn't work out, you can't convert it to anything. How do you think about alternative use as downside protection, and whether that's relevant to your investment approach?
Yeah, it's a really good question. And look, I do think it's an overlay you should be mindful of. Having said that, if you get the secular demand drivers right, you're not looking for that alternative use. You're looking for more supply. And that's really the situation I want to be in, is an undersupplied world where you're not trying to pivot away from a failed demand driver, you're trying to lean into it. I do think a little bit, I'll have a bit of fun with taxonomy for a second, this notion of traditional sector real estate. Like if someone said to you, well, I'm a traditional corporate equity investor, like what does that mean? You like buying railroads? You like buying, companies from 90 years ago? Like that's not what we would consider to be cutting edge equity investing today. I think you can take a similar mindset to real estate, and you should really think about these demand drivers as sort of the first screening criteria for that. I also think that notion that alternative use is downside cover is a little bit of a cold comfort idea that helps you underwrite, but in reality doesn't ever work out. Like, tell me what the alternative use for a Class B office building is today. Could I reposition it as a hotel? Sure, with 100% capex. Could I make it a vertical data center? Yeah, for $250 million. It doesn't have that many alternative uses. And so we fool ourselves when we think that's true, but look at how many people have tried to figure out how to repurpose office buildings just here in New York City, converting them to student housing, converting them to hotels. The vast majority of that just doesn't work because there really isn't an alternative use. And so if your demand driver dries up, it's lonely out there. And so to me, get the demand driver right, and then we can worry about the rest.
Absolutely. What about digital infrastructure, data centers? You guys have been active in Asia and Europe, less so in the US. Any thoughts at the moment on data centers?
Yeah, sure. It's a popular topic, and I'm probably going to be mildly controversial about it. We love data centers. We've for 9 years now owned a company called Bridge Data in Asia, which is one of the 2 largest data center platforms in Asia. That has been a phenomenally successful investment for us. We just recently announced an investment in a company called Minerva in Europe, which is a alternative energy, green energy backed data center platform in partnership with Aquila Energy in Europe, and Bridge Data, who has a cost development advantage in data centers. And so clearly we like it. I think if you take the thematic approach that we believe in this focus on demand drivers, it's obvious, we're blowing out the growth of data in the world, and there's genuine convexity to that demand. One of the kind of amazing things about demand drivers there is it's not linear. As computing power grows, applications grow. Why do we not have driverless cars today? Because we don't have the computing power to figure out how to power every car in New York City in a driverless way. Once computing power gets there, that application comes online, and that's a whole bunch more demand, and that's a whole bunch more data. And so it just keeps feeding itself in this exponential sort of way. The difference, however, and this is the thing I'm worried about at the moment, this is the point of controversy, is that the supply equation functions fundamentally different in data centers than any other segment of real estate. In every other segment of real estate we're used to, a unit of occupancy, the nth unit of occupancy, is almost definitionally more expensive than the previous unit of occupancy. The margin is always more costly, right? Inflation drives up construction cost, land costs go up over time. And so if I want 1 more square foot, it's going to cost more than the last square foot cost, almost tautologically. That is not true in data centers. Every unit of computing power is cheaper than the last unit of computing power because of the way we're increasing processing power, because of the way we're increasing storing density, because of the way cooling technologies are growing. You don't have this linearly expensive supply curve. You actually have a concave supply curve. And so you've got convex demand and concave supply. And I don't know how those two will interface in the long term. But I know that if you're buying a data center today at a 5 cap, you're betting that that data center stays relevant for 20 years without any capital servicing costs. And so 2 things I worry about. One, I worry that we are slightly overestimating the ongoing capital burden of these data centers. We don't sign leases in data centers. We sign service level agreements, and you have to continue to provide that service level over time. That may mean I have to reinvest in the data center, new cooling technology, more energy, better power, better layout, better configuration to optimize for those SLAs. And that's a drag. The equity markets make this mistake when they talk about companies through the prism of EBITDA multiples. Like, they don't look at ongoing capital costs. Same thing's true here. If you put a 5 cap on something, you're not burdening that for an ongoing capital drag. And so I'm worried that we're sort of being a little dismissive of that ongoing capital drag. The other thing I'm highly mindful of is, and the last panel I thought did a great job of talking about that, is you get into these alternative segments of real estate, the executional burden goes way up. you've got to be really good to do this stuff. Three guys in a truck used to be able to build an office building because they had a friend who was on the city council and they knew a guy in construction and they could make it happen. Three guys in a truck can't build a data center and lease it to a hyperscaler. That's just not going to work, though there's a lot of people trying that business plan right now. The question you need to ask if you want to go into the sector is, am I going in with somebody who is competitively advantaged? Do you have edge in that sector? And there are people who have that in the United States who've built a ton of data centers and have phenomenal hyperscaler relationships. And if I were going to bet, I would bet with those folks. We've not done a lot in the U.S. because I don't own a source of competitive advantage in the U.S. And I hold that bar really, really disciplined. In Asia, we own the most advantaged data center platform. And so we're all in. In Europe, I think green energy and being aligned with the power grid future of Europe is going to be a source of competitive advantage. And so by partnering with Aquila, the largest alternative energy provider, we think we have unfair advantage in that market as well. But barring a clean answer to why we're the right people, why this is the right platform, no thematic is good enough to go chase it in an undifferentiated way. And so I've got some anxiety at the moment. I can't remember who it was in the last panel who said, is data centers today's life sciences? It might well be, right? It's a 20-year thematic that's obviously right. It could be that a little too much capital is chasing it right now in the short term. And so if I were looking for a way to play U.S. data centers, which it's my job to look for, I'd say, we're going to be a little patient. We're going to wait and see if this is a bit of a hype cycle and then buy the hangover, because I believe the 20-year answer fundamentally in all the way. But attaching yourself at the right moment in the price paradigm matters too. And we're definitely at a pretty peak moment in the price paradigm right now.
Well, speaking of timing, let's shift to the macro and the cycle if we could. Where do you think we are in the real estate cycle, and what are your views post-election on the macro environment and how it's going to impact real estate broadly and then your sectors?
Yeah, sure. I mean, a bit of an awkward question because I said 20 minutes ago I'm a terrible macroeconomist, but I'll try. Our firm has had this house view for the last 3 years that's been really unpopular, but now may sound familiar, and the house view was higher for longer. We just believed fundamentally that interest rates were going up and they were going to stay sticky at that altitude. A lot of reasons for that. We don't need to go into all of them, but that was our view. The year started, the market was pricing 6 or 7 rate cuts. The house view at Bain Capital was 2. We've sort of long had this view that rates will be stickier on the high end of the curve than people think. For a year, I heard the opposite from the real estate market. What I heard was the Fed's just about to relent, that big cut's around the corner. Once they roll over, once we get into a compressing rate environment, cap rates will start falling, banks will start lending again, and everything will be okay. And so everybody went and blended and extended and bought themselves 12 to 24 months to sort of live through that moment in time for that glory day of cutting that's coming. The election happened, and suddenly what I hear from capital is we might be in a higher for longer environment. Why? Well, we're going to run bigger deficits. We're going to have a stronger US dollar because we're probably going to put some tariffs on some people. Those are not things that are disinflationary. Those are not things that argue for a low interest rate environment. And what'd you see in the back of the election? The 10-year blew out and ran to 4.45 because the market started to appreciate that, geez, there might be some more pressure here. And I think the Fed has started to appreciate that they value the tool. If the economy is ripping and we can hold rates in the high 3s, low 4s, why would we cut them? That's a tool we can save for a rainy day when the economy is not ripping and then use it for what it's intended to do, which is stimulate the economy in a down cycle. And so we kind of think we're in this higher for longer world. What does that mean for real estate? Well, I'll tell you 3 things it means. One, I think it means we're in for a bumpy ride. These next few years, you could see some real turbulence. The market kicked the can for a year and a half and nobody really called the question. But we've seen lenders in the last month start to get a lot more aggressive, start to demand pay downs, start to really look at coverage ratios and say, we've got to solve this problem because I'm not convinced the Fed's going to relent and that you'll be all okay next year. That's going to force some crisis. That's going to force some stress. And that's a good thing to take advantage of if you're greedy. The second thing I think it means is that investors will start to move out the risk spectrum. If I can get 5 for holding government debt, if I can get 7 for corporate debt, holding equity real estate, I'm going to need more than a 6% core return for that. And so I'm going to start moving out that risk spectrum, embracing value add and opportunistic real estate more and more because it fits my allocation objectives. And the third thing I think it means is that you really need to lean into high quality NOI streams, that you're not just leveraging low beta cash flows anymore. That was the last 15 years. I could go buy a stable 5 cap, multifamily asset, lever it 75% at 3.5, and that was pretty good thing. And by the way, when I go to sell it in 6 years, it's going to be at a 4 cap because treasuries have come down another 50 basis points. And I look like a brilliant investor having done that. That's not actually a super high quality NOI stream. It's just beta. It's just GDP. I think increasingly as we look for return, we've got to go look for places where I can grow NOI greater than GDP, where I can create some asymmetry in that NOI growth. And so that's going to lead us more and more into sort of alternative sectors, niche sectors, mismatched supply-demand sectors of real estate, where you're taking advantage of that supply-demand mismatch to get above average GDP NOI growth. The watch out as we do that, I would say, that stuff is harder. If I buy a commodity office building or lever up a commodity multifamily income stream, I can fire my manager tomorrow and hire 14 more people. If CBRE is not leasing the building, JLL will lease the building. There's tons of people who can just take advantage of that for me. If I get into small suite, ready to occupy, warm shell, life science lab space, there's not 75 people who know how to operate that product really well. There's like 1.5 in the world. And so I better be one of those people, or else I'm on the wrong side of that trade. And so this notion of where are you competitively advantaged? Where are you the right person to play there? It's going to matter a whole lot more. And I think we're seeing that in these sectors as capital sort of runs in, chasing that higher quality growth, chasing that, more bespoke return, but without competitive advantage. I think the difference between winners and losers and people who know what they're doing and don't know what they're doing, it's just going to get wider and wider and wider. And so, holding yourself to a bar of where are you advantaged, that's going to be a really relevant question in the alpha market to come.
Great. What about global allocation, US versus Europe versus Asia? Are there some sort of strong views you have on where to put real estate capital to work in the next few years?
Yeah, look, we're a global firm, and I do believe in global markets. Money moves pretty fluidly, and I think money has lots of different objectives. And so horses for courses, and no one style or strategy of investing is right for every investor. Having said that, I'm a huge believer in U.S. equities. I do believe Asia's got a lot of interesting opportunity to it, but it is a hyper-local set of opportunities. You've got to be in country. You've got to be native to that country. You've got to know what you're doing in those countries. We've got offices all over Asia because you can't just serve it out of one country. You've got to be local everywhere. If you can do that, I think there's good money to be made. But I think you've got to pick your spots really carefully and know what you're doing. I think Europe is going through a repurposing cycle at the moment, and there's opportunity in that transition if you know how to play it well. But just buying a basket of European equities is a little bit scary to the market at the moment. But U.S. equities, it's a pretty winning strategy. Goldman Sachs every quarter publishes this wealth report where they sort of give investment advice to high net worth individuals. And last quarter, their opening stuck with me where they said, we've written this report 134 times. And 134 times we've recommended one strategy, long U.S. equities. And 134 times we've been right. It sort of stays with you. It's a pretty obvious realization. But their point was macroeconomics is inherently comparative. And on a comparative basis, the U.S. is the best off country, best off economy in the world. We're the reserve currency of the world. We have the strongest economy in the world right now. We have the best innovation in the world right now, and probably the best systems for that innovation. And as a result, we're going to outperform. And so, yes, other people have growth drivers that come and go. And yes, there's pockets of hyper growth you can access around the world. But if you're looking for just fundamentally comparatively better returns, logic sort of says long U.S. equities is a pretty good place to be, over the cycle.
Great. You talked about AI in some of the investment themes. Is there sort of any direct impact that AI has had on your business practices to date? And do you see that changing over time?
Yeah, we all talk about AI. You have to. It's going to change our lives for sure. And I can't begin to imagine what life in 30 years will be like because of AI. So, ignoring it is at your peril. I try to wrap my mind around it this way because I'm a simple guy. I think about it in 3 buckets. There is an application of AI that just automates rote processes, that brings you better data, that brings you better analysis, that can take some of the boring stuff that we have associates do every day and do it faster and better for you. And we're leaning into that full steam. How do we leverage AI to tap the data that we have as a platform? How do we build a language learning model that can take advantage of all the things we've ever done at Bain Capital and give us insight that would be harder to find without the advantage of those big language tools? How do we process data sets faster? we've just got to do it. The funny thing about that is that innovation is coming from the bottom up, not the top down. The analysts and associates at Bain Capital are way better at using AI than I will ever be. And so let them loose. Empower them, give them a walled garden, give them tools, and let them figure out how to light the business up with it. And I've been amazingly surprised and encouraged by a lot of the things we've been learning from our teams as they've done that. On the other end of the spectrum, there's the big thematic disruptions. Where will AI crater industries? Where will AI change the way, whole industries work? And at the moment, we tend to think about that as a little bit of a grading of the thematic. Things where it's pretty obvious AI will be hyper disruptive. Computer programming, probably not a secular demand driver I want to lean into for the long term. Data centers, other side of that, it affects these thematics in a big way. There's this middle box that I think is where all the hype is at, that at the moment I think is a lot more smoke than fire. This notion that AI is becoming a decision maker, that AI is an investor. People who tell you we've got an AI engine that has a vote in our investment committee now. I want to see that engine. I want to understand how it's voting. Because we've tried a lot. We've put a lot of resources against this problem. I do still think there's a layer of human judgment that matters in investing. And I think a machine can make a lot of good recommendations and it can provide you with a lot of good insight. But how you stitch that together in a multi-sectional way, that's a uniquely human process at the moment. And so it may be coming, and I might be out of a job in 10 years and just give your money to a machine. But so far, I haven't seen that middle filled in. It's disruptive to industries. It changes our day-to-day activities. But I'm not sure it's going to replace the core of human activity.
Brian, are there any sort of favorite books that you've read recently and/or podcasts that you could share with us? Love to hear how you use those to sort of keep up with the world?
Yeah, sure. I was, up until the election, I was a political junkie, and I've detached a little bit here the last couple of weeks. You can read into that what you will. So I was consuming a lot of those podcasts before. I do think books are a great way to borrow someone's brain, and I try to read a little bit of a nonfiction, fiction on-off cycle. As I came into the world of real estate, I consumed a lot of books about real estate because I was trying to learn as fast as I could. And since we're in New York, I'll plug one I thought was particularly good, was sort of The Liar's Ball, the history of the GM building here in New York. If you've not read it, I highly recommend it. It's a colorful read. It goes through 6 sagas of that building, which has been owned from, everybody from Blackstone to Donald Trump. And all the war stories that go into it are just a fascinating read about this real estate ecosystem and a particular asset. So that's one I think very highly of. And then, I think a lot about probabilities. And you can hear in the way I talk this notion of symmetry and asymmetry, and convexity plays a lot to my mind. And so the Taleb books, like the Black Swan and those sort of things that stretch our minds about how wide that fan really is, have been really informative to me. I mean, the first thing I tell people their very first day at Bain Capital is, we're never right. Ever as a firm. We've built 1,000 models and we've never had an asset perform the way the model said it would. The question is, how are you going to be wrong? And the quicker you can get your brain out of linear, I'm right, here's the math, here's the proof, and into I'm wrong, and here's the ways I'm probably wrong, and here's what that means, the better the investor you become. And the most important lesson we try to leave them with is that fan is always wider than you think. And even when you think it's sufficiently wide, there are outcomes that you haven't thought of outside of that. And that humility, I think, makes you a curious and good investor.
Great. Wanted to open it up for some audience Q&A.
We can see nothing, by the way.
Yeah,
so feel free to just shout out.
If anyone's got a question.
I'll just stand up and ask the question. My name is Asif, and Ryan, thanks for the talk. You talked about the strategies that you have in capital across different asset classes. Could you talk about any thoughts that you have about investments that might be derivative to those trends? Say, for example, prefabricated construction, modular construction, or even on-construction sites. Robotic installation, masonry, any of those areas that are secondary to things you've talked about?
Yeah, for sure. We spend a lot of time thinking about these things. How does technology speed along development? How do we leverage new construction methods? How do we build better product cheaper? We've spent a lot of time candidly looking for sort of prefab, modularized, assembled housing products. And there are some interesting startups out there that are doing that right now. We've struggled at the moment, at least, to find something that we think is sufficiently high quality and sufficiently cost advantage to solve that equation. A lot of that assembly line product that's coming off the assembly line is still actually relatively expensive. I think it will come down that cost curve quickly. People will figure this out, and I think there's a big future there in new construction technologies. But at the scale we play at, it's really just not accessible at that scale and at the right price point quite yet. But I see it coming. And if I were an earlier stage venture investor, if I were a smaller stage seed investor, I'd be spending a lot of time around exactly the kind of thing you're talking about, looking at ways you can disrupt that construction ecosystem and deliver product cheaper.
We talk a lot about sort of these niche sectors, and I think the same sort of themes come up over and over. But are there sort of niches that you think are sort of further out on the spectrum that you guys are beginning to investigate that that might be particularly interesting?
Yeah, sure. I'll give you a couple answers to that question. I think there's niche things that I don't think the world necessarily thinks of as real estate yet, that I probably think of as real estate. A good example I would give you is marinas, where you put your boats. You got to be smart about this. A lake marina in the Ozarks is not really a precious piece of real estate, but a marina in Boston Harbor is a very precious piece of real estate. We're never going to build another one. All the waterfront's developed. There's environmental zoning reasons. There's a whole bunch of local protests against it. Nobody wants a marina in their backyard. And so there's zero supply growth there. And at the same time, you've got some real secular demand growth in that sector. Wealthy people keep getting wealthier, and they have a habit of buying toys, and then they have a habit of buying bigger toys. And so linear feet of boat that are owned in the world is growing pretty darn fast right now, without any supply response that's available in those high net worth coastal markets. And so to me, that's really precious real estate. That's tangible assets. It's physical property that has a secular demand driver and has fixed supply behind it. That's the thing we're running into. We love that kind of idea because we think it's tomorrow's real estate today. I think there's another version of niche real estate, which is sort of just getting into that, as I was talking about housing, the sort of getting 2 or 3 clicks sharper in the curve. And so, I heard the last panel joke about sort of storage. Anything you can store is interesting. Well, that's a place where you can find a lot of these interesting niche pockets. Fine art storage, bonded warehouses, for example, wine storage. These are unique assets that take operational excellence to deliver what the customer needs, but are also fundamentally real estate assets with recurring revenue and contractual leases to them. And so we like that a lot. And then I'll give you a third answer to the question, which may be a little bit surprising for all the things I've said. I do think there's a little bit of sometimes old things are new again. And I think there's places in traditional sectors where you can find niche thematics that are still highly relevant. I'll give you 2 examples. Within the working and office ecosystem, medical outpatient buildings to me are a fascinating case of workspaces. Co-located with a hospital whose goal is to drive care out of the hospital and into an outpatient facility, doctors that want a higher quality, space for their patients, and an ecosystem that keeps them all localized there. That's a special demand driver, which we're all consuming more healthcare, and it's a fixed supply asset because it needs to be in that hospital ecosystem with the right hospital partner with the right philosophy. If I can find those assets, right now they're trading like office buildings. They're trading at 7 to 9 caps, but they've got way better fundamentals than an office building does. And so that's a niche of an old sector that I like quite a lot. The other one I'll tell you I like a lot at the moment is grocery-anchored retail. Open air, necessity-based, grocery-anchored retail. Retail got oversold. We all hated it. But that world has fundamentally changed. I came from the world of consumer retail, so I understand it a little bit. But if you think about your grocery-anchored retail center 10 years ago, it was a grocery store where we were worried that, food delivery was going to kill the grocery store. It was 2 clothing boutiques that were getting killed by D2C commerce. It was a stationery store that was getting killed by Amazon. It was a tax preparer who was getting killed by the internet. It was just a whole bunch of people who were saying to you every year, if you raise my rents, I'm out of business. That was not a great asset. Look at that center today. The grocery store is still there, and billions of dollars of venture money haven't made a dent in it. Amazon owns grocery stores. The grocery store is here to stay because it's the most efficient last mile food delivery vehicle in the world. At the same time, The rest of the center is totally different. Those clothing stores have been replaced by Lululemon and Apple stores, things that we have real demand for and that are relevant for the future. The tax prep guy has been replaced by a skincare spa, a med spa, day spa. There's a daycare center, a Bright Horizons for the kids there. There's a Outpad now that's got a Chick-fil-A and a Starbucks in it that are highly relevant businesses. And none of that is going anywhere. We know well the average return on that box for the tenant is something between 30 and 50% a year on their rent a year. And so I can raise those rents. I can push NOI in those centers and it won't hurt my tenants. And as I start to re-tenant to those higher quality occupants, well, the whole center becomes more vibrant and then I can take rate again. And so to us, that's a case of finding the niche within the traditional sector that is a little bit mispriced because retail's out of favor, but that capital has to go somewhere. That 52% of money I said was in retail and office buildings, it's not all coming out of real estate. It's going to go into these other sectors. And so you need depth. It can't all go into multifamily. It can't all go into logistics. There just isn't enough in the world for that to be economical. And so it's got to find its way into not, grocery anchored retail. It's got to find its way into medical office buildings. And if you can get sharper about even those traditional sectors where you play in them, I think there's tons of pockets of opportunity.
Thank you for all the ideas here. What the common theme, or at least some of the common things I've noticed within the niche asset classes is sort of they tend to be operationally intensive. You better know what you're doing for the downside protection. How do you feel about, or what are your thoughts on having that expertise in-house within the firm versus maybe having a joint venture format with an operating partner?
Yeah, I think this is a really great question because, as I said, I think as you move into these harder to operate, more complicated segments of real estate, the alpha, the operational, value add is just way more important. And so, being obsessed with what's my source of competitive advantage is kind of the most important question with what's the secular demand driver today. I think there's a change coming in the world of real estate. You can still work through JVs. You can work through programmatic operating partners. You can control and own operating partners. There's a lot of ways to go do that. But one of the fundamental design features of our model is using exclusive operating partners. This notion of operators who just shop deals around for capital. I think that's going to evolve differently in the future because as you get expertise in these spaces, you've got to co-create and co-develop these platforms. There's a learning loop to them. There's an intentionality of business building. There's a staffing plan that has to come behind that. There's skills that we need to put into that platform. And so that dialectic of, are we building what we need to generate that competitive advantage? That's something I need to be a part of. I don't just trust the operator that, hey, you seem good at this. Like it's evolving. We're learning. We've got to keep learning together. And so, making 1 and 1 = 3, finding that partnership and co-creating that edge is going to be crucially important. And so I just, to me, the comment that was made on the panel before us that there is this blending of private equity business building skills and real estate investing is just one of the most true things I've heard today. That our skills in how do you build competitively advantaged companies, that's the future of real estate investing. How do you build competitively advantaged operators who run a data center better than somebody else, who know more about life sciences than somebody else, who have more development expertise than somebody else? If you don't have that, you shouldn't be playing the game. And so my ability to build that, I think, is going to become one of the more valued and prized skills in alternative investing. And I think we're all headed in that direction.
Great. Well, on that note, I want to thank everyone for coming and, wrap up this panel. And thank you, Ron.
Thank you, Raphael. Pleasure.
Thank you for listening to the Real Estate Forum, a podcast brought to you by the Paul Milstein Center for Real Estate at Columbia Business School. Be sure to subscribe for more insights from real estate thought leaders, industry professionals, faculty, and the latest research and expertise from the Milstein Center's Research Lab at Columbia Business School. If you've enjoyed the episode, please follow, rate, and share the podcast. You can keep up to date with the Paul Milstein Center for Real Estate at business.columbia.edu/real estate. Thanks again for joining us, and we will see you next time.